Good morning and welcome to today's Yellowstone Advisory webinar with Alan Foy, Chief Executive of Smart Metering Systems. While we're waiting for everyone to arrive, I'm going to put up a poll on your screen and I'll just ask you to respond to that so we can see the mix of holders and non-holders here. So let me just put that poll up on screen. And I'll just keep that poll up there while I introduce you to Alan Foy. He's the Chief Executive of Smart Metering Systems. I know you can't see a picture of him this morning. We've had a couple of technical issues, but he is there. Alan has been Chief Executive since 2007 and led the flotation of the company onto the stock market in 2011. He's a 5% shareholder and added to his position earlier this year buying another 500,000 shares. So he's really aligned with shareholders. Alan is going to provide an introduction to the company and update on recent activities, financial performance and group future strategy. We've got everyone here on listen only mode. If you want to ask a question, please type into the chat box at the bottom, the Q&A function there. We've had a few questions in ahead of time and we'll cover all questions at the end of the presentation. The format today is going to be a presentation from Alan that will last approximately 25 to 30 minutes, and then we'll have 10 to 15 minutes available for Q&A. So I'm just going to now close the poll and share that with you, and then I'm going to so we've got a mixture here, generally non-holders. And now I'm going to hand over to Alan Foy to take us through today's presentation. Alan,
Okay, thank you, Alec, and good morning, everyone, and thank you for taking the time this morning. We've prepared a presentation which I would like to take you through. It will talk about, just an overview of our business, the position that we're in our market, and then take you through some operational, financial key messages. And then the outlook, and see where strategically we see ourselves moving in the future with our business. So if I take you through to our overview, as I mentioned, we've been in the industry for 25 years, but where we are now at the end of 2019 is that we've got what we call index-linked annualized recurring revenue from our business, and what we've got at the end of 2019 over £90 million in index-linked annualised recurring income, and that comes from investing in assets, and our assets is metering assets, which is a critical asset to the UK energy infrastructure. And we contract with the licensed energy suppliers. They're our counterparties, and we send invoices to them at the end of the month, and we get paid promptly by them. And these assets last in excess of 20 years, and we get paid under in perpetuity contracts. They're evergreen contracts. So we know that when we start at the beginning of 2020, then there'll be £90.1 million coming in. Now, we also took the opportunity earlier this year to dispose of around 18% of that. So we brought that annualised recurring income. It's now down at just about £76 million at 31st of May. And we'll talk you through what we've done with the proceeds from the disposal and the valuation that we got for about 18% of that recurring revenue. And so we see ourselves now, we're a business that we don't have any debt currently. A key metric in our business is a sustainable long-term and growing dividend, with clear upside potential from our existing contracted order book, but also as we move into further assets beyond the meters. Metering assets has provided a baseline of an asset class that provides data which really enables carbon reduction assets to come behind them. And what we mean by that is any asset that we install is all aimed at reducing carbon, meters being the key one. But it then levers into batteries, electric vehicle charging infrastructure, solar, and a whole array of carbon reduction assets. And we see ourselves moving into that with our long-established energy management business, and in partnership with Columbia Threadneedle will enable us at the very outset to establish a market rate for these assets, the new asset classes that we will move into. And so you can see that sustainability is really at the heart of SMS. 100% of what we do is aimed at reducing carbon through installing assets that help customers reduce their energy consumption and their carbon output. Smart meters is the key carbon reduction asset, and allows us to then develop these further assets and help our customers reduce their carbon footprints further. So just stepping back, we actually started our business back in 1995. I joined in 2004. From 95 to 2004, we were a service business where we provided electrical and gas connections and infrastructure on behalf of licensed energy supplier customers and an array of end consumer developers. In 2004, we changed our business model. As well as doing that infrastructure design, we started to then take ownership of the meters that previously were being defaulted to National Grid under a monopoly. So 2004 was effective competition. As when I joined the business, and we changed it to an investment business and an asset owning business. We've progressively grown organically. We listed the business in 2011 to bring in, to strengthen our balance sheet and bring in some capital. And then it's all about positioning for our business. So as well as growing organically and continuing to add meters, we made a series of acquisitions from 2014 to 2018, and that was really positioning ourselves for the domestic smart meter rollout, which we've got nearly 1.2, 1.3 million meters fitted now, and an order book now of 2 million meters beyond 2020 that will take us to 2024. So really, by 2020 this year, we sold down some of our assets. We've got a positive cash balance of 48 million, annualised recurring income of 76 million, and a strong dividend policy. But very importantly, with a very strong order book to add a further 2 million smart meters to the portfolio that we've got, and then move into all of the care assets that we've just been speaking about. So really, business positioning is at the key of us. What we've done as a result of selling down some of our assets is that we restated our dividend policy. Our dividend policy is now at 25 pence. It grows at least in line with RPI. All of our contracts increase by RPI. There's no downward pressure on our RPI. There's a floor of 0, so they can only go stay the same as last year or increase. Now, we've been very prudent with our dividend. The ratio, or the cash cover ratio, is 2 times. So we know that in a steady state business, our annualised recurring income would come in, and we would very much be able to increase that dividend. But we're holding that back because we've got substantial growth. But we see that there's clearly further dividend upside through the clear operating cash cover, notwithstanding the additional incremental long-term recurring revenue streams that we will add from our order book and beyond. So as I say, leverage, we have a net cash position. We've got 48 million pounds. We have got an RCF in place of 300 million. That, coupled with the excess cash from operations, will well cover the 2 million smart meter order book and some more. The 2 million order book will actually add about 40 million pounds onto the annualised recurring income that we've currently got. And we've stated that leverage will keep to a prudent 3 to 4 times, but in reality, we don't see that going above 3. So really, the story of our business is sustainable dividends, but growth in meters. 40 million to be added to the 76 is over 50% growth projections in our business, keeping leverage below 3, and we've got potential beyond that. Our customers, in fact, have got an additional 4 million meters to be exchanged that they've not yet committed. So we have got some growth pipeline beyond the 2 million order book in meters. And then it takes us to our carbon reduction assets. We're very much positioned for this upcoming energy revolution, as we say, because the UK is the first major economy to put into law that they're going to go to zero emissions target by 2050. Now, the Committee of Climate Change estimates that the actual estimate is between 50 and 70 billion pounds a year required in capital investment to reduce carbon by 2050. That equates to around £1 trillion in investment. And as we start to see all these new assets, electrification of heat, electrification of transport, batteries, retirement of coal, retirement of gas, we see that these levels of capital are quite realistic. And as we step into that, the very outset, we would look to our partner, Columbia Threadneedle. They've got an open-ended fund, very well motivated to invest in these asset classes. And we see ourselves at the embryo stage of that as using their capital so that immediately these assets that we bring in will be value accretive. We would get a development fee for originating them, and then we would get an ongoing management fee. And clearly these additional and enhancing revenue streams gives us further opportunity to increase the dividends as well. So if I take through an operational view, the first thing to really at the heart of our business is ESG. We feel that we lead as a sustainable leader in the market. We've been in the market as energy services since 1995. Our first contract for energy services was in 1997, and we've still got that contract. Over the last few years, we've implemented many carbon reduction strategies for our customers, which has resulted in like 9 times saving in carbon. In other words, we've saved carbon and only left about 1/9 of carbon footprint that was there before. So our handprint is 9 times what was left behind. So we've really got a very positive perspective on ESG. We are recognised with the Green Economy certification from London Stock Exchange, finalists of fleet management, etc. And really energy sustainability governance all round about that is really at the core of SMS's business. Every asset class that we install is 100% clearly an ESG asset. The smart meters, as we say, are the first ESG asset. They are essential to achieve a net zero ambition. Without having the data on half-hourly on every electricity meter, we will not be able to use an efficient network for delivery of transport, heat, etc. So electricity generation and supply really needs the smart meters so that it can flex between the volatile solar and wind energy that comes into the UK, so that it can optimise and bring that excess energy into decentralised generation and storage, and when the sun and the wind isn't there, bring it back as well. All sorts of energy efficiencies, electrification of transports, everything needs data to optimise it and really make it work. And that is the whole reason for smart meters. And we can see that government estimate anywhere between 14 to 19% of carbon reduction is going to be as a result of smart meters. So there's a really key asset to achieving a decarbonised economy. And an operating review, as we mentioned earlier, the index-linked recurrent income is £76 million at May, with no debt, but we are going to add 40 million annualised recurring income to that. So we can clearly see that, you know, from 75.9 as a standalone business, we pay out a dividend of 25 pence, which is about 28.5 million. So we've got like 2 times cover in a dividend payout, but we have got growth beyond that, maintaining that as a 2 times cover. So the overall market has still got, you know, just over 36, nearly 37 million meters to be exchanged. But importantly, our customers that we've got this order book from have still got 4 million meters in their portfolio to be exchanged, and that's clearly a focus of our sales team to continue to do what we do and hopefully move into another 4 million meters to be exchanged. To put that into context, if we were to secure all of that 4 million, it would be an additional 80 million in annualised recurring income. That's on top of the 40 million that we've got as a secure order book at the moment. Our energy management platform for the carbon reduction assets, like meters, we invest in our IT platforms. In 2004, when we moved into meters, we invested from handheld equipment for engineers right the way through as to how we control, operate and track the assets across each of the energy suppliers in the UK. We're very much an IT business with operations that are out there that originate the assets for our IT platforms to then manage them. And we've got exactly the same in our energy management division. We have got data analytics where we collect data from meters, analyse it, do monitoring and targeting, highlight to our customers where they're consuming energy when they shouldn't be consuming energy, bill validations, help them with their procurement, do energy surveys, and then design and project management of the installation of carbon reduction assets, whether that be CHP equipment, batteries, solar, etc., and then show them exactly the savings that they've made as a result of those capital investments. We recently purchased Solo Energy because there was one key ingredient that we didn't have in our full end-to-end IT platform, and that was the ability to control the charge and discharge of batteries on the grid and in people's homes in response to over-generation of wind on the network, where we can collect that over-generation rather than currently wind plants being switched off. In these instances, they can stay on and we can collect that energy in our batteries. And likewise, when the solar's not there or the wind's not there, we can discharge the batteries and put that energy back into the network. Our energy management business has got an array of customers, major industrials, telecom companies, network rail, etc., etc., and it makes around about 2 million EBITDA. So it makes a positive contribution to our business just now. But at this moment in time, it's been using our clients' money to install carbon reduction assets. Over the last 4 or 5 years, there's been about 120 million of carbon reduction assets that we've been designing and installing, controlling and managing for our customers, but using their capital. And we see that with so much capital required to get to net zero, clicking in can be a thread needle, and being able to originate these assets and really accelerate the carbon, the route to carbon zero by 2050, accelerate our customers' plans to reduce their carbon footprint, but also save them money. So the care assets that we're looking at and investing and get experience in is energy efficient systems and heating and ventilating and air conditioning, LED lighting. We've just finished a large project for LED lighting for a major hotel chain, energy storage, which is really what Solo Energy brings us, and their ability to control batteries in response to the volatile energy generation through wind and solar. Electric vehicle charging, data and control virtual power plants, heating will be electrified going forward. And we have got, experience in dealing in various sectors, from the telecom majors to major banks as our customers, Santander, for example, national pub chains, as well as all the existing energy suppliers. So really feeling very well positioned for that market with all of the IT platforms in place, and now with the partnership with Combia Threadneedle, we're very confident in moving forward and taking on these assets using Combia Threadneedle's balance sheet. The financial review and the capital structure. Well, our income statement, as you see, is our group revenue 114 million. A clear aspect of you see from December 18, 98 going up to 114, you would naturally see our revenue going up as a result of annualised recurring income. We invest in 1 year, but we invest in every day of the year. So our overall investment in 1 year, we can only collect the revenue or half of the revenue in that year. So the following year, you would always see an uptick. The divisional performance, as you'd expect in the asset management division, which is index-linked recurring income, is just a steady increase all the time. So we've already got growth, if you like, locked into this year from the activities that we've done last year. Our asset installation business, we do all of the smart installation work in-house. We had a reshaping of our run rates last year as the industry moved from the foundation meters into the main rollout meters. We reshaped our run rate and got ourselves at this moment in time to a very solid position for carrying on with our order book into 2024. And our energy management business, as you see at the bottom, has got gross profits 2.2 million. It's got a stable 1.4, 1.5 million from its ongoing recurring demand and data management, and then it makes additional contributions from one-off development fees. Like, for example, we had an energy efficient lighting contract which we just concluded last year, and which just put the profits up a wee bit there as well. And so we see the energy management business as a robust and solid platform for growth moving forward. But the main thing in our business is our group cash flow. Our group cash flow, as you can see in 2019, it started with £30 million in the bank. Cash from operations 42, and then we drew finance from our facilities, invested in assets, a bit of debt service, and we paid our dividends, and we end the year with £50 million in cash. And so when you move into 2020, we've got currently in our bank in May, we'll get £48 million, but we've got no debt. So we've got no debt servicing. Cash from operations very strong. We'll invest in more assets, and so you can very clearly see that our net debt EBITDA are going to be very small over the next couple of years, and that gives us the opportunity to pay the dividend that we've publicly stated. The funding is meter assets. We're well funded for our metering assets from our 300 million RCF, our cash from operations. We'll keep leverage at very low single figures, 1, 2, something like that in terms of leverage. And on the care assets, we'll use the Combia Threadneedle partnership. So we'll use their balance sheet initially, and that enables us to get one-off development fee and then incremental operating and management fee. And so it just becomes cash generative to our business as we install these assets, and further opportunities to rebase the dividend. Dividend 25 pence per share. It grows at least in line with RPI. We gave that flexibility for ourselves. RPI is going down at the moment, but we've got to grow at least in line with RPI. And clearly we can see that the headroom is in our business for restating that policy as we move forward. We pay the dividends quarterly. We start in October, and as we say, we've got plenty of headroom. We're a debt-free business, and we've got additional index-linked annualised recurring income from the metering estate, which lasts more than 20 years to cover that dividend. So the outlook for our business, well, the metering and the data activities in our business is real focus of our business. The exchange programme for smart meters will go to 2024. We've got our 25p dividend, we're 2 times cash covered, but we are just going to add another 40 million of index-linked recurring income, keeping our leverage very low while we do that. But we have got further opportunity with our existing customers to add another 80 million in recurring revenue on top of that. And we are now starting to accelerate our carbon reduction activities, which is moving into other asset classes like batteries, using the FlexiGrid platform that we purchased in from Solo Energy, CHP power plants, electrification of transport, storage, lighting projects, etc. And as we say, that we see that there's substantial amount of capital to be installed in these assets. For example, the overall smart metering market to exchange all of the meters in the UK would cost around 1.1 to 1.2 billion, whereas in the carbon reduction investments, we're looking at around about 50 billion a year between now and 2050. So we see a substantial and large and sustainable market, and one that we're very well positioned for. So that concludes my presentation. I'm happy to take questions and answers, Alec, from yourself.
Thank you, Alan. Thank you, Alan, for that presentation on the company. And you clearly enjoyed some pretty impressive growth over the last few years, and it sounds like there's more to come with the existing pipeline that you've got. Also interesting to hear, I guess, the role of smart meters have in the overall country's attitude to energy reduction and environmental issues. So thank you for that. We've had a number of questions that have received ahead of time, and some have come on during this presentation. Just a reminder, there's a Q&A box at the bottom, and we'll try and get through to all the questions if we have time for. So let me just start with the first question that we've got here. So, you know, over the last 25 years, smart metering systems has been at the forefront of UK energy transition by enabling carbon reduction and improving energy efficiency and reducing consumer bills. If you look forward, what are you excited about in the future, and where do you want to see the group 5 years from now?
Oh, well, I say SMS, I mean, we've been in the utility industry now for 25 years. Our history shows that we invest significantly in developing infrastructure. Our IT platforms, you know, for the first one was for the government mandated smart meter rollout, we invested very heavily, managed to get a good market share there and build trust with our energy supplier customers. So we're very much a right arm to our energy suppliers, so we control their smart meter rollout, which they require to do through their licence obligations. And you know, the smart meters themselves, they're really at the heart of the energy transition. Without the smart meters, there would be no mass adoption of wind, solar, electric vehicles, batteries. All of these carbon reduction assets really can't happen efficiently without the smart meters and getting the data, and really a digitalisation of our networks. You know, and the smart meters themselves, even Ofgem, they consider they save around £250 a year, or will save £250 a year in their annual bills. So it really is an area that they're going to make cost savings. But the main thing is that they're going to reduce carbon. As soon as they start reducing costs, they're not using as much energy, they're going to reduce carbons. Again, Ofgem rating about 45 million tonnes of carbon, about equivalent of 26 million cars off the road. So it really is a sustainable and really an ESG asset class. But we've got a long journey. We've still got a 2 million order book to install. We've still got customers with over 4 million. So we've really got a focus over the next 5 years is to take our annualised recurring income from 76 million and really increased that. We've got 40 million in our order book. We've got another 80 million as a potential pipeline, and that is our core focus. So in 5 years' time, we want to be a business that's came through the smart meter rollout and really maximise that opportunity. But alongside that, we've had our energy management business, and our energy management business has been going for 25 years. It makes about 2 million EBITDA to our business. But really the market is opening up for that business now, because as a result of the smart meters, we're now seeing government legislating carbon zero by 2050. And really what that means is that we need to electrification of transport, heat. We need to balance renewable energy generation through battery technology, and we've really clicked in all along the IT platforms to allow us to help the UK transition there. In addition to that, we've got in-house expertise where we actually provide electrical connections and design and infrastructure for the UK electricity distribution companies. You know, for example, Network Rail, we designed the networks for Olympic Park. We're doing the high-speed rail 2 infrastructure. We provided the management and construction for the connections to Hinkley Power Station. So we're very well steeped in the electrical infrastructure design in the UK, and I think very, very well positioned to transition to that, help the UK transition to this clean and green environment, where we see our government have even suggested, you know, there's around about £1 trillion of investment required over the next 30 years. And we'll be able to do that through our partnership with Columbia Threadneedle. So next 5 years, focus on the metering programme, and then we'll be establishing a further carbon reduction assets.
Sounds like there's a huge amount of growth there, but just to pick up something you mentioned in your answer, which might be more immediate for a number of people, which is you said that consumers could save £250 on their annual bill. How can they do that?
Well, there's evidence for that right now. I mean, if you take it, there's really the here and the now is, if you go and get now that there's so many smart meters being fitted, if you go to an energy supplier, many of them are saying conditional on having a smart meter, they will be able to give you a reduced tariff. And we're seeing those reduced tariffs as upwards of £150 a year in savings. That means that the energy supplier can incentivise the consumer to start using energy at the weekend, or using their washing or their iron at the weekend, and give them a reduced rate at the weekend, or one of them was even giving them free electricity at the weekend, because it was taking the demand off during the week where the electricity costs are very high. So just having the smart meters allows a shift in electricity consumption, which saves the energy supplier. We've seen it right so far that the energy suppliers are passing that through. The further thing for the energy suppliers is that once they've got that data, they have got much, much less billing inquiries. You know, you imagine at the moment, you read the meter once every 6 months. Sometimes it's an estimated read, and they just get billing inquiries. So removing all of that, getting into a telecoms type structure where they know exactly what you're using at all times, reduces the back office costs for the energy suppliers. So there's savings right now from smart meters of over £150 a year. But then as you move forward to a carbon neutral environment, without smart meters, we would just be putting renewable energy onto the network. The network would be an increase in the demand through electrification of transport, would just be putting so much demand on the network that we would need to build more central power stations, and we would need to increase the size of the cables going all over the UK to carry that extra energy at that peak time. But with the smart meters, we can then start to say to the charge points for cars, for example, network's full just now, the following hour or the following 2 hours, or charge it overnight, and start to use the network when it's not being used at the moment to its maximum efficiency. And that will save capital investment in underground cables, in central generation plants, and that's huge savings. I think that the estimates that Ofgem are coming out with of £250 are exceptionally conservative, to be honest. But notwithstanding that, even through the operations and installing all the smart meters, we're replacing meters that are 40 and 50 years old. You know, we depreciate our assets over 20 years, but the existing meters out there, ones that we're replacing, are 40 and 50 years old. So it's a good chance at this moment in time to do a safety check, bring things up to current standards, etc. So I think that's been overdue in the industry as well. So as well as making things safer, get safety checks in there, I think consumers will ultimately, I think £250 conservative.
Okay, thanks for that, Alan. We've had quite a few questions in about the dividends. Obviously, it's been a key focus more recently in the market, with quite a lot of companies cutting their dividends. You've done something completely different, and I guess quadrupled the dividend. So I wondered if you could just provide a little bit more context around the dividends and your confidence in the ability to pay that. And just to remind us, I know you mentioned it, but just to clarify, SMS have their dividends index linked, or at least index linked, and what happens if inflation is negative, and how does that impact the dividend?
Yeah, well, I mean, since we came to the listed markets, 9 years ago, to 2011, we have invested significant capital. We've been a very cash generative business, and what we've been doing with that cash is just reinvesting it and reinvesting it and reinvesting it. We started in 2012 a small, but almost like a disciplined dividend. So we were always going to be a dividend story, but we were very much using all the cash from operations to invest in our business. We raised capital again to strengthen our balance sheet. Our net debt EBITDA was getting above 3, and we raised capital in 2017. But we also sold a minority of our assets. We sold our older assets, we kept our younger ones. We sold about just over 18 million of recurring revenue. So that brought us back down to the 76 that we've currently got. But we sold those assets were nearly 5 years old, and we sold them for a 16.4 multiple. The kind of read across, if you like, as if they were brand new, it could have been over 21 times multiple. And you bear in mind that when we invest in all of these smart meters, the IT platforms are all there. There's marginal, if not no, increase in operating costs. There's no maintenance on these meters, so they just drop straight down to EBITDA. So therefore, the growth in adding annualized recurring income is very visible. Our investors can clearly see that for every 10 or 20 or 40 million of index-linked recurring income, it just drops down to EBITDA. So we're very well covered for. We think that we've started, because we sold these assets. We chose a 2 times cash cover as to be very conservative, to give investors extreme confidence that our dividends are sustainable. We put in that they will be RPI, at least RPI escalating, so that gives us flexibility where RPI is low to increase the dividend. But very importantly, and just on your point, is our contracts increase by RPI, but there's a floor of 0. So they will never, our revenues will never be any less than what they were the previous year. So negative inflation just does not affect SMS. But even that 25 pence dividend, I mean, in our market cap just now is about 4.5% yield, which is covered 2 times. If we were a steady state business and we never had growth, then we should really be bringing that down to a 1 to 1.1 times cover, and almost doubling that dividend. So it's got an underlying 9%, if you like, yield. But we're holding that money back. We've got growth. We want to give everyone confidence that that dividend's there. It's sustainable. It's a growing dividend, and not just the metering assets that's going to add from the current order book 50% growth, we've got the additional potential in meters, and clearly moving into the carbon reduction assets is very exciting for us.
Okay, thank you. Got a question here, really just looking at how does SMS rate themselves on the issues of ESG and sustainable themes. These have obviously been brought forward a bit more by COVID-19, but how do you rate SMS on these metrics?
I think SMS, I mean, everything that we do, we see ourselves as 100% sustainable. Everything that we do as a business. People say, you know, what does our staff get out of bed in the morning for? What are they motivated for? Everything that we do is to reduce carbon. We will look back in 20 years, 30 years, and we'll tell our grandkids, we are all here to reduce carbon, to create a clean environment. And the deployment of smart meters is the first stage. We'll then move on. Our ambition is to be really at the heart of this whole carbon revolution. There's renewed focus globally, governments, etc. Back in the UK government being the first to actually mandate a zero carbon by 2050, we are exceptionally well positioned to support that transition. So I think moving forward, we'll see our ratings for ESG go up. We're only at the embryo stage, but we're very much 100% of what we do is aimed towards sustainability.
Okay, thanks, Alan. I'm afraid we're almost out of time now, so I'm going to ask one more question. Any questions, though, that haven't been answered, we'll endeavour to give an email response after the webinar. So apologies if there are any unanswered questions. So the final question has been, has there been any impact of COVID-19 on SMS operations?
Really, in two parts. In one part, we were not able to install as many smart meters as we would like, because clearly our main programs all had to suspend. So our incremental index-linked recurring income has reduced for around those 3-4 months of COVID. But that will be picked up. It's not as if those orders have went away. They're still there to be done. And the regulator extended the target by 6 months to allow everyone to catch all of that up. So really in the long term, no real effect on index-linked recurring income. The other positive effect, however, is that our cash has grown. Because we've not been investing and using some cash from our operations to invest in these assets, we've been holding that. So our cash balance has grown. And, you know, that really gives, if we take the effect of COVID and use them as exceptional costs, if you like, you know, for standing down engineers, then our cash is actually built in our business. So that it's a strange thing, is, you know, we suspend operations and installing meters, and our cash increases, our PBT increases, because we're not reinvesting that cash in other operations. And very importantly, we moved into that COVID position with a very strong cash balance, having disposed of some assets and had no debt servicing. So hence all of these things lead us to a strong cash position in our business as a result of that. But also we supported all of our customers with emergency call-outs, because what we found is that with people being in lockdown, shops being closed, a lot of the traditional metering portfolio, you have to go to a shop to charge credit on a card and then go back and put it into your home. And, you know, with increased electricity consumption, with people being home, there was more and more people running out of electricity when they were on a prepayment. So our emergency services has actually been quite strong. So I think it's just shown that with a left field business disruption, our business model is exceptionally resilient to it. And we're coming through this very strong indeed financially.
Alan, thank you very much for that. And look, thank you everyone for attending today. Apologies if we haven't come and answered all questions. As I said, we will try and endeavour to do that after the webinar. But just wanted to say thank you for attending. And as you'll leave, you'll come to a survey, and we'd very much appreciate it if you could complete that. And finally, if you've got any questions that haven't been answered and you want to send them in, please send them to info@yellowstoneadvisory.com. So thank you very much for attending today's webinar with Alan Foy, Chief Executive of Smart Metering Systems. Goodbye, and we hope to see you soon.